Hi, my name is Jim Rector, and I am the asset manager for Ethos IRR.
Hi, I'm Mike Reyna, managing member of Ethos IRR.
Hi, I'm Brent Conlin, managing partner with Espada Real Estate. Thank you.
I'd like for everybody to welcome Brent, tell him thank you for bearing with us and trying to muddle through. All right, well, that leads us to the capital stack question.
Yeah.
We think that, there's some finance geeks that might watch this. There's some investors that watch this. But the truth is, most of them are just going to be real. I mean, what is a capital? What does that mean?
Well, a lot of people, too, is, just if we want to invest in the fund, or they say, hey, I want to see what the developer does or Brent's company.
How does this work?
I like to invest with these guys. If it's not direct with us, it could be
maybe
direct
with you. Yeah,
exactly. So, a lot of people, when we throw out these long words, terms over pushing dirt, or the what do they call it?
Our vernacular.
The powder's dry.
Oh yeah.
We got dry powder ready for the market change.
Our capital stack. So
ROIs.
ROIs.
Cash yields.
Yeah, exactly. So just for the public, just so they know what's a capital stack, and then now they're learning what a developer does, what we kind of do. We come in side by side with our money and our partners' money with you side by side on deals. So just kind of explain how that would work in your mind. As far as you.
Well, I think fundamentally speaking, capital stack is just that. It is the combination of resources, predominantly fiscal, so there's money, typically structured as equity or debt, some variations thereof, but it could also be land. Not terribly unusual at all for us to have a joint venture partner who's contributing land in kind as capital to the partnership, and that's part of that asset base. But generally speaking, capital stack is the culmination of equity and debt resources that are needed to execute and operate the property, presumably profitably, right?
Right.
And then through our activities of development and operations, we then return capital back to those sources in the capital stack, pay off our debt service to our lender.
Always first, huh?
Always first, sometimes first and second, as we talk about different kinds of debt. But ultimately, the equity of which we are a part in every deal we do, we want to make sure and get that equity back with a yield. And there are two different types of expectations, I think, any investor should have in a real estate deal or an income-producing asset deal. They should have a return of capital, return on capital, right?
We talked about that.
Yeah, right. And so that's a big part of the equity coming into the deal. And your investors may or may not understand how they differ from being equity versus debt and where they are in that stack relative to priority of repayment.
Right.
The downside of equity is it's behind debt almost always. The upside is that equity is really kind of boundless in the opportunity of what it can earn. That debt position is kind of fixed. It's got a cost associated with it, and maybe that rate varies tied to some other unrelated indice. Maybe it doesn't, depending on how well we've managed that process, right? But equity theoretically stands the chance to really compound and create meaningful yield off of any given investment based on the success of the investment itself. So that maybe is the question. Do you want to be debt and have that senior position, but really be capped at what you can get, but the higher degree of certainty you're going to get your money back? Or would you rather be in kind of that entrepreneurial type position? It's like, I want my money to be in there. I want it to be working. I don't mind being delayed a little bit and getting it back, but I really want some juicy yield out of it.
Right.
So that's really kind of the difference, I think, maybe that you're seeking.
We could talk about it all the time. It's like, I had a meeting this morning. There was a real estate side component to this, and there's a equity side. And so we're always trying to beat the equity guys,
Right.
And they're saying, well, the market went up with this and that in the stock market. Well, how much dividend did you produce? It's really to that. And we always kind of go back to what real estate is. It's the cash flow. And so you're looking at cash on cash and then return up. But then talk about as a developer, obviously you're going to pay back. And as far as if somebody on one team says, hey, Brent, we want to invest with you, not even with Ethos. Ethos wants to invest with you, obviously. We're going to partner with you. But if somebody said, hey, I want to throw land in or whatever, kind of walk in, a private investor says, hey, I want to invest with you. What do I do?
Yeah, what are the mechanics of that?
Mechanics with that?
Okay. So typically the first thing we do is we form a legal partnership, file it with the state. So there's an entity now created for the purpose of this pursuit. We then each contribute to that pursuit. The landowner is going to contribute his land. He's really relinquishing title of his land to this partnership. Now he, in return, gets a vested ownership interest in that partnership. Let's call it a limited partnership for simplicity's sake. That is representative of his allocation of contribution relative to the total allocation of equity to that limited partnership. Additional capital comes in. That's going to come in from us as the general partner contributing as a limited partner. There may be additional LP partners, Ethos IRR, individual investors, what have you, and everybody's going to get their pro rata percentage of ownership of that new legal entity. So that legal entity becomes a going concern. It has its own mission statement, if you will. We're going to take this property, we're going to develop it. This is the plan, this is the execution strategy, this is the exit strategy. As we deliver that product and it starts creating income, we start making distributions. Obviously, debt service is getting paid per the terms of its debt facility contract, its note, all along the way. And that's relatively static or fixed, easily calculable no matter what. Equity is a little trickier. We often see a landowner or more often than not a capital contributor signing up for a deal that's carrying a preferred return, a stated preferred return. Now, that preferred return is not guaranteed. It's when we start making distributions, from the time you contribute your money to the time we start making distributions, that preferred return is accruing as a yield on your contributed capital. And the first money, more often than not always, deals are structured a lot of different ways, particularly with complex waterfalls and different hurdles and everything else as you get into different tiers and types of partners that are participating as equity contributors. But generally speaking, the first money out of the deal after debt service that's distributed to equity pays down that accrued preferred return, interest, right? Until that is paid current. And then every additional dollar that's distributed, so long as pref is current, is paid to reduce the investor's capital account, so their original capital contribution. So obviously, as their capital balance goes down, the continuing accrual of their preferred return is also less, right? They're accruing that yield on a lower and lower principal balance, just like a note.
Goes away,
till it goes away. So we, at some point in the life cycle of a good project, a lot of times it comes down to the reversion or the sale of that asset. Could be a refinance, but more often than not a sale. There's a pretty substantial capital event where there's a lot of money that's being distributed all at one time. So pref gets caught up first, capital contribution gets paid second, and then you're kind of at this point like, oh, but there's a whole pot of gold down here at the bottom of this rainbow, right? Knock on wood, we've done a good job.
So we see checks,
right? So that's profits interest or more amongst us, talking about developer vernacular. That is the promote. So, well, what is a promote? Well, promote is someone who is getting a piece of that capital distribution, rather, without having necessarily having it be equated to a capital contribution. So a developer, more often than not,
they bring the deals. They have
they get paid to
back-end payment only when the deal is successful to a point that profit's been generated and all the other capital has been repaid. Not always, but most of the time. That's how it's structured. That they get a pretty substantial piece of that pie, and maybe that piece of that pie grows bigger the more and more profitable
the waterfall
the yield is back to the original capital. But that is a pre-negotiated, predefined, documented component of the structure right up front. It's not something that is based on a look back or, hey, we think it ought to be. This is you're signing up for this, and at this point, if we get you X return on and of your capital, we're going to start to participate as the general partner or as the operator of this asset, just in profits.
So as the investor, if I invest with you after the promote, I've already got my preferred return. Right?
You've got your preferred return,
and
which is your return
to participate on the back end of that.
Yeah. So more often than not, the investor group is still getting a pretty substantial, if not the majority, of that promoted piece of the deal
to sell of the asset.
And we've all probably seen it range anywhere from the LP equity getting anywhere from 50-50 with the developer to 70-30, somewhere in there is kind of the sweet spot, depending on a lot of other variables in the deal.
I see this as that type of vehicle is just amazing, because otherwise you invest in a bank, CD or you invest in stock. I mean, you're at the mercy of somebody else. Here, at least, you know, pick up the phone, call, yell at you if we have to. We don't like the color that you put on this pink thing or the purple. Or we just go look at it and say, I like it. And it's just running smoothly.
When
I'm getting a
can
return.
see and taste and smell.
Yeah, from a developer standpoint, I mean, it's you see it, you see it from paper, see it going ground up. And then at the end, you see the whole, this is what we're going to do, Mike. This. Here's the history. And then when you sell it and you get that one check, you get your money back. Plus you get money on top of that. And then I get another kind of a return on that. I mean, I don't see much stock doing that or anything other type of investment.
So you bring up two things that are pretty common questions or points of consternation with equity investors, particularly if they're debating should they invest in a real estate deal or should they go buy something that's more highly liquid like stocks, bonds, your traditional liquid assets. And the first thing is the understanding the preferred return.
Yes.
Like, yes, you're not getting that distribution. It's not a true dividend where you're going to get that cash out at the end of the year, but it's accruing and you can see a statement of your capital account so you can see the growth of your money. Yeah. Again, no guarantee that you will get it, but if you believe in the project and the operator is executing on the plan, then in all likelihood you will. It's not if, it's when. The other thing is a challenge with LP investors and where aligning with the right type of equity is so critical is because of that promote structure, there's an inherent conflict of the developer in order to get paid that back end piece, right? You've got to have some significant capital event which allows you to get the pref and the original equity paid back as quickly as possible. So the developer just, again, instinctively has a kind of a predetermined path. We got to get to that point of inflection in this deal as quickly as possible. And it's not in conflict with the equity at all, but if you have a pool of equity that really wants to hold this asset, maybe even multi-generationally, rather than we want to put 25-year money on this thing and just hold it forever, or pay it off, not take distributions at all, and let's just own it debt-free forever and ever and ever. Well, a developer who's not getting paid until you get to that inflection point of promote or profitability, they're saying, well, let's at least refinance this thing.
Right. Yeah.
So you're kind of forcing these large capital event occurrences in order to get to the payday. So what I've seen predominantly in hospitality deals that we've invested in as LPs is some kind of a machination of the traditional deal that we've been talking about, and that promote, instead of waiting to kick in until after pref and original equity have been fully repaid, pref is paid current, and then the general partner or operator gets paid a piece. It's not a 40 or 50% piece. Maybe it's 10% until equity gets to some hurdle rate of return, and then that grows to 20% once they get to the next hurdle rate of return. But that helps align the interest, the long-term interest of both the GP and the LP, so that the asset can be operated and financially structured to align with everybody's interests and goals. I mean, those are the two biggest challenges, I think, with most
for any investor out there that just says, hey, I want to get in real estate, I don't know how to do it, what's step one and stuff like that. Imagine, are y'all looking for investors that
always
okay.
The hard part for us right now has been finding deals that we can go execute on in short term. We have been doing large 200,000 square foot plus stabilized power centers around the country, competing to win them. We've been trekking along doing like 2 of those a year the last couple of years, 3 or 4 years. We'd love to do more, but in order to do more, we've got to really ratchet up our equity. The average equity on those deals is somewhere in the neighborhood of 20-25 million each. So, we're placing somewhere in the neighborhood of $25-50 million a year just in those assets. Okay. Historically, the kind of bread and butter has been the $3 to $10 million projects where we're raising $1 to $3 million of equity. Right. 50% or more of that is coming in our own conference table. Yeah.
It's easy to get them done.
You do 10 of those a year, and you start building a really nice portfolio.
I'd rather get on first base than try to hit the
assets
grand
that we
slam
can
all the
manage that are local. We can put eyes and ears on them every day if we need to.
That sounds a lot.
So we love
really
that
good.
stuff. Yeah.
Well, good. Well, we're going to kind of recap here at this point, and we've already talked about the developer's role and how they partner with us is Ethos. And again, I want to thank you for coming in and talking to us. You've
My
been
treat.
a wealth of knowledge, and you have a stellar reputation.
Yeah.
You know, you're
I did
literally
until today.
one of the smarter guys I know in real estate. You know, not at
You
all.
can cut that out.
You know, and I want to encourage our listeners to reach out to us. We're going to give you Brent's contact information. You can reach out directly to him.
Right.
We want anybody to feel free. You know, you don't have to you go through us to get to Brent. Feel free to go to Brent. And you know, I don't know who we're going to have on next. We might have a banker on here and talk to them about lending and how they, you know, what they look at.
Mm-hmm.
But I really do want to thank you, and I want to ask you, you know, close with something about Espada and tell me
tell me kind of
you know,
what's been your
what's the coolest
you
thing
think?
you've
Yeah,
ever
yeah.
worked on your whole career? Let's
Oh,
back
wow.
up.
Yeah.
Let's go back to a deal and say what's the project that caused you the most grief, most difficult to get done, or the coolest?
The last one. I'm not just kidding. The next
good
one.
as your last
Probably the
deal.
next one, really. So I had an opportunity in the last phase of my tenure with Crow, and I actually negotiated to take the project with me when I left, was a Bass Pro Shop anchored deal down in the Rio Grande Valley.
Oh wow,
Not big deal, but what really made it interesting and
those
what
are big deals.
That's a
huge
Yeah.
deal. But what I really learned about it and what makes it so fascinating is not because of the deal. It's not even because of who the tenant is and how complex their lease is. But I had the opportunity to work with city officials that were really pro-business. And like we were all sitting down, scratching, how can we make this work?
Oh nice.
Sitting down with their bond financiers, which you don't get a chance to do.
Let me ask you a
in this
question.
role
Did you have to pay them some amount of money to get them to come?
Bass Pro Shop? I think we threw a couple nickels at them.
Okay.
Yeah.
That's what I thought.
The city sure did. There were big
Heck
general
yeah.
bond issues.
Oh yeah.
But the degree of financing and creativity and being on a
The
team where you had
difficulty to
true
finance,
public-private partnership trying to achieve the same goal that had meaningful impact on a community.
Yeah.
And it obviously was really beneficial for the residual land
Oh, their sales
that we
tax.
kept
I mean,
around
you-
it.
you
We
can-
actually donated the land for Bass Pro Shop to the EDC. The EDC signed the lease. We were party to a 3-party agreement.
Oh wow.
But we had additional acres that we're still trying to develop
Sure,
around that.
pad
Honestly,
sites
that
available.
much land, yeah. But it was just a really cool deal to be talking about really complex financing and economic development tools. I learned a lot,
Nice.
and it. That was back in 2010, so kind of midpoint in my career. To have the opportunity to really open up a new door and learn a lot. You look for those opportunities. I think the older you get, the more you look to learn, right?
Yeah,
Absolutely.
History becomes relevant. It's like, oh, that's kind of interesting how this has happened before. Yeah. So that was really, really cool. I've done some really cool small stuff.
Yeah,
working
absolutely.
on a little 3-acre piece that we bought from the city of San Antonio a couple years ago. We did a deal, ground lease with Darden. We're trying to do a ground lease with another pad user right now. Hoping to have that lease done in the next few weeks if all goes well.
Nice.
Not a barn burner that you're going to put on the front brochure of your company.
No,
But a really cool deal where
Basics.
we didn't have to contribute a lot of capital in a marketplace where it's really hard
sure.
to have that capital deployable and generate return that's just not there. To be able to do that through ground leasing instruments and find tenants that are so eager to get engaged in the marketplace that they make it work. I love working through the hard stuff.
Yeah.
I want easier deals. Don't get me wrong, but it is
Are there any easy deals ever?
invigorating to be able to work through something that somebody else couldn't. Maybe.
Yeah.
We're very, very conservative. I take grief from my own partners. Just like you're way too conservative in your underwriting. We've lost a lot more deals than we've won as a result.
Yeah.
But I think
And we've seen our competitors, quite frankly, step up and do them.
Oh yeah, and they hit it out of the park.
Not always, but a lot of
No,
times
a lot
it
of
does
times they
happen.
fall.
Yeah.
I'd rather, like I've always said, I'd rather get on base than try to hit the grand slam
Absolutely.
or strike out.
I'd rather miss
And
an
I
opportunity.
really appreciate that comment, being conservative. We love that, especially from our investors.
Yeah.
They, we're conservative.
We're not looking to hit home
I want to
runs.
sleep. I love to sleep at night. I love my sleep. And so if I know that everything's taken care of, the developers doing their job, our money's secure.
It's safe. They're spinning it like they're
That's
spinning their own
important.
because
I
they're
think
spinning
everybody
their own.
likes that for sure.
Well, as you compare us to others, I would just say look at their portfolio loan to value.
We do.
How highly are they leveraged? What kind of cash balances do they carry as a percentage of operating capital? These are things that we found valuable before the pandemic, and as we entered the pandemic, to be in really strong cash positions with our assets. And not to have leverage breathing down our necks, that we were in favorable positions to have the difficult conversations with lenders. There were only 2 that we had to have just to be on the safe side. but it was a much better. We didn't lose a lot of sleep. We were one
There
of the
you go.
first, if not the first, to step out to our tenants and say, "Hey, listen, here's 90 days.
Yeah.
No rent due. We'll figure it out. We'll tack it on to the back of your lease. We'll renegotiate an extension. We'll figure something out. Do what
You're
you
a
got to
true
do."
partner.
Yeah.
Yeah,
With
we
your
look at it that way.
partners.
Yeah. Well,
in
we're
that
also
business
property
sense.
manager on a lot
Right,
of the stuff we
so-
do too. So it's our team going out there and dealing with them, eliminate the headache before it
Absolutely.
comes. You know, drink that bottle of water before you go to bed after that bottle of wine.
And
Yeah,
Brent, always
Thank you, Brent.
pleasure, man.
Yeah,
Thank you
enjoyed
so
it.
much,
Thank you
man.
both.
Have a happy
Appreciate it.
holiday.
Thank
that was
you.
fun.
Y'all
Merry
be
Christmas.
safe.
Yeah,
And,
Absolutely.
thank you
Let's
for
do
doing
this
this.
again sometime.
Absolutely.
Okay. All right. Sounds
have
good.
me on. I'll grill somebody else.
Absolutely.
Thank you.
Thanks.
Are we good?